Now to talk about it all and what it means for the economy going forward, Michael Englund, a chief economist at Action Economics, one of Bloomberg's best. Bloomberg's best means we bring you only the best people on the economy. We've crunched those numbers to find the most accurate forecast in the world, and Michael sure makes the list. Welcome to you. Like to begin with those initial jobless claims. Rising more than expected, does it set off a red flag? Are you concerned that this is a signal that the broader jobs recovery is going to stall a little bit here?
Well, I think what it really does is raises a red flag for next Thursday's report, which will be quite important for the market. We got a big pop this week. We got a big pop last week as well, and the Department of Labor attributed both to the Easter holiday. One might expect more of a zigzag pattern, but of course, if we get the big drop next week, I think most people will probably forget the bounce we've seen the last couple of weeks. But if we don't drop back as far as we should, and we're looking for a number in the 450 area next week, if we stay up in the 460, 470 area, it might suggest that improvement in the labor market's stalling, and that's going to be annoying to the markets, given that we are really having trouble breaking back into positive job growth and getting anywhere near the 100 to 150,000 payroll gains we need each month just to keep up with the labor force.
Is the initial jobless claims here reading today, Michael, a signal that we might drop back into negative payrolls growth in the next jobs report?
Well, it might be. You know, we had a very solid jobs report in March. Many people saw that as a correction to the February storms. But there's a lot of noise in all the labor market data. So we've gotten essentially a net negative signal from these claims numbers as we approach this BLS survey week, which would be the next week's claims number. The good news is that the employment components of the two factory sentiment surveys today, the Empire State and the Philly Fed report, look pretty strong. And the Philly Fed number, we saw a decline in employment, but a gain in the work week. We saw some pretty big employment-related gains in the Empire reports. If you look at the whole mix of available April job data, it does look like we're still improving gradually.
What about the industrial production read this morning? Again, a few tenths slower than expected. This had been a stronger area of recovery. So is this a blip?
Well, you know, we're encouraged by the pattern that we've seen in industrial production into March. The headline number was fairly lean. They revised up the last couple of months. In general, the factory sector has been growing 6 to 8% over the last 3 quarters. It's been a really nice bounce. Third and fourth quarters was largely a correction to the vehicle sector coming out of its bankruptcy. We saw big ramping up in vehicle assemblies. So we have to a certain degree, write off some of that bounce. And a lot of the first quarter was utility output. December through February were very cold months. We had some unusually high readings there. We unwound those in March. So April, I think, as with much of the economic data, will be a real indicator of where we're going coming out of the volatility of the February and March data.
I'm taking through the data points we got this morning before the bell. Capacity utilization, obviously something key the Fed looks at, basically flat, but still holding below that long-term average of 80%. Is that going to mean the Fed's going to keep this extended period and keep rates low for the time being?
Well, certainly it's a big chunk of their argument. You know, there are those that claim that as long as capacity utilization is low, there's really little upside risk to inflation. And to people that think that, it's pretty clear that for the next couple of years, there's really no chance that we're going to have a high capacity utilization rate. Even though industrial production is growing, it's going to have to ratchet up quite a ways before we're actually going to have tightness in the U.S. factory sector. So that's good news for inflation. The people who are more concerned about inflation tend to look further into the future. Right. They're more concerned about commodity price movements that may not be that related to the utilization rate.
I think it's fair to say no one's really worried about inflation, rather deflationary concerns right now. But what I want to do with you, Michael, here is wrap it all together, right? Because there's this heated debate right now about what the Fed should do with interest rates. Obviously, there are a lot of sectors in the economy that are coming right along, revving right along, but there's also a lot of weak points. We talked about unemployment, also a lot of issues with credit remaining. So what is the Fed to do? And are you concerned right now about bubbles because interest rates have already been so low for a pretty good amount of time?
Well, we are in the camp that's more concerned about the long-run impact on a potential bubble in the financial markets from excessively easy policy than we are concerned about the Fed moving too soon. We do think the Fed is in stall mode with its rhetoric. It's going to keep rates low as long as it feels the market will sustain its credibility with that position. I think at some point through the year, the market is going to test the Fed. They're going to start wondering whether or not a near-zero Fed funds rate is the best place for rates. And we'd point out the Fed has largely dropped the reins on rates with short-term rates at zero. They're nowhere near other market yields.
Michael,
and if they were at some point to move the short-term rate to 1% or 2%, for instance, it may not have an adverse effect on the economy.
Do you think these improving conditions or the economy will continue at this expansion pace once the Fed does raise interest rates?
Well, we do think that the initial effect in the markets of the Fed starting its tightening cycle, which we think will probably come early next year, will probably be adverse. But in the long run, we think the bond market will like to see the Fed normalize policy. And I think as rhetoric shifts through the year, you might find that as the Fed adopts a more symmetric view on the economy and the risks, bond yields may actually not rise as much as they would have if they kept rates low.
So let me press you on this issue of an asset bubble. Some are wondering if the stock market's a bit of a bubble right now, considering this rapid tear of gains we've seen in recent weeks.
Well, it certainly could be a component of it. And if you talk to people in the markets, there's quite a dichotomy. You know, those who look at capacity utilization rates, who really see no upside inflation risk, they're really in one camp. And on the other camp, the concern is that historically the Fed tends to move by too little, too late. And with the funds rate starting at 0%, the concern really isn't this year or next year. As you know, we're not going to be seeing any inflation in the pipeline in the next year or two. The question is going to be 2014 to 2018, and we have a huge supply of Treasury securities to be hitting the market over that period. So that, I think, is the concern that the hawks have on the inflation front. It's a long-term concern. It's not a concern over the next year or two.
Michael Englund of Action Economics, the chief economist and one of Bloomberg's best. Thank you so much for your time.